M1 Finance versus Robinhood. In this video, I'm going to tell you which platform is best for you. Each platform has a different set of features and products that are tailored towards different types of users. Ultimately, the best platform for you depends on your investment style. Do you want to be a passive investor or an active trader? Passive investors believe that history is an indicator that the stock market always goes up if given enough time. For this reason, they tend to be patient and use a buy and hold strategy, which naturally requires a lower trade frequency. Lower risk, stable market conditions suit them best, so they can slowly but surely grow a big gain over a long-term horizon. Just set it and forget it.
Set it and forget it.
Active traders tend to buy and sell stocks frequently because their goal is to capitalize on all the short-term ups and downs of the market. For this reason, a stable market wouldn't provide them enough opportunities to make profits, which is why they prefer high volatility. This buy and sell approach is very hands-on and can easily require as much attention and commitment as a full-time job. Let's get started. Which platform is best for investors and which platform is best for traders? What is rebalancing? Rebalancing is a way to ensure that your portfolio does not deviate or drift from the initial asset allocations that you have selected. For example, let's say you have $200 to invest. You know that stocks are riskier than bonds but have higher returns, so you decide that a safe asset allocation is 50% stocks and 50% bonds. That means that out of the 200, 100 will go to stocks and 100 will go to bonds. Now, let's say 5 years later, your stocks have gained in value, leaving your portfolio at $900 in stocks and still $100 in bonds. That's a 90 to 10 ratio. Now, you might be thinking, who cares about the ratio? My stocks are doing great. But again, stocks are risky, and to minimize your risk, you previously decided that a 50 to 50 ratio was best for you. That's your money, and the majority of your money is now in high-risk assets. If stocks crash several years down the line, you would lose all that good return instead of some of it sitting safely in bonds. The inverse, of course, could also be true. Stocks or bonds could go up or down, and that's why investors decide their risk tolerance before they invest, so that their investments can weather all the ups and downs. That's where rebalancing comes in. In our example, the investor could sell stocks and buy bonds to rebalance their portfolio. You might have noticed another benefit. Rebalancing allows investors to sell high and buy low, which means they can sell high-performing assets and reinvest that money into assets that have not yet experienced growth. An automatic rebalancing feature would definitely benefit passive investors because it maintains the asset allocation of their portfolio without manual work, especially if they plan on holding investments for decades, which they typically do, because it gives them the freedom of not needing to constantly check their portfolio to rebalance. This is perfect for an investor who will gladly wait many years for a return if it means not having to put in a lot of work. Active traders are often looking to buy and sell frequently in order to make gains more quickly. If you're a swing trader and you're reading charts to decide when to get in and out of a certain position, rebalancing will hardly matter to your strategy. Rebalancing is often about hedging risk, and active traders use other tools to hedge their risk. For instance, they can set up stop losses, or they can make sure that no more than 2% of their capital is invested in a single trade. Robinhood does not have a rebalancing feature, and it's unlikely that active traders would benefit immensely from this feature. But for passive investors for which this feature is imperative, M1 Finance wins because it has two types of rebalancing. Manual rebalancing sells positions that are overweight, then buys positions that are underweight. With dynamic rebalancing, any dividends you reinvest or money you add will automatically go to underweight pies. So over a long period of time, the ratios you set up will be maintained. A share is one unit of stock, and a fractional share is a portion of that unit. For example, at the making of this video, Amazon stock is $2,000. If you only had $500, you wouldn't be able to invest in Amazon unless you had access to fractional shares. Fractional shares are useful for passive investors, especially if they're using rebalancing, because it helps them rebalance their portfolio more effectively. For example, if a stock trades at $500 per share, the rebalancing operation will result in a remainder if you don't have exactly $500. Without fractional shares, you will have leftover money after the rebalancing operation, just sitting there, not working. Lazy, lazy, lazy. The same is true if you've accumulated some dividends that you want to reinvest. If it's not enough to buy a whole share, then you can't reinvest those dividends. Do active traders need fractional shares? Sure, they could benefit, but let's say you're an intraday trader doing more than 5 trades a day. For full-time day traders in the United States, the legal minimum balance required to day trade stocks, ETFs, bonds, and options is $25,000. And even if you're not day trading per se, there is also a recommended minimum depending on your trading style. So sure, traders could benefit from fractional shares, but fractional shares seem more about making investing accessible to everyone, so I don't see the lack of fractional shares being a deal breaker for active traders. At the making of this video, Robinhood introduced fractional shares. However, there's a wait list. I've been on that wait list for several months, and it's not really clear when fractional shares are going to be available to everybody. But in the meantime, M1 Finance does have fractional shares. So for passive investors, M1 Finance wins in this category. Cryptocurrency and options trading. You can buy and sell or trade cryptocurrency like Bitcoin. It's similar to trading stocks or global currencies through Forex, but it's different in the sense that cryptocurrency is unregulated, much more volatile, experimental, and decentralized. Generally speaking, options trading involves betting that a stock will be above or below a certain price on a certain day. For typical passive investors, they are unlikely to want the ability to trade cryptocurrency or options. Both are very risky and involve high levels of expertise. Options are definitely complicated. You have to learn about expiration dates and other trading rules, be generally good with numbers, have discipline, and plan out your trades carefully. Neither are for the set it and forget it type. For a passive investor who wants low risk, low effort, and low volatility, crypto and options trading are both out of their league. For expert active traders who make money on volatility and want fast profits, the ability to trade something as liquid as crypto or options is probably super appealing. Trading crypto and options requires lots of research and time commitment because you'll always be checking the charts to determine when's the best time to get in or out. Especially with options, time is not your friend. But active traders are not averse to this. In fact, they probably enjoy it. Also, day trading options can further be appealing because it's cheaper to purchase an option than to buy the underlying asset. For example, one option represents 100 shares. So you can control the same number of shares with far less capital. M1 Finance does not offer cryptocurrency or options trading, but Robinhood does. For active traders who are looking to dip their toes into cryptocurrency or options, Robinhood would be a great platform for that. Curated portfolios are basically pre-assembled and managed portfolios that have preset allocations of securities. Passive investors would benefit from curated portfolios because they generally do not want to spend their time checking or otherwise managing their portfolios. And newcomers who find investing too overwhelming to get started would definitely benefit because pre-assembled portfolios make investing surprisingly quick and incredibly easy. Active traders typically want to be involved and selective with the securities that they end up trading. Curated portfolios often have algorithms working in the background, which means that active traders won't be able to make personalized changes to such portfolios. Imagine a day trader studying charts or researching companies and handpicking ETFs or stocks, then choosing to be confined to the securities in a curated portfolio. It just doesn't make sense for their style. Robinhood does not have curated portfolios, so for passive investors, M1 Finance wins in this category. They call their curated portfolios expert pies, and I would say their expert pies are quite comprehensive. They have hedge fund mimicking pies, a cannabis pie, and general investing pies that are tailored based on risk tolerance. I'm actually invested in their moderately conservative pie. I find it beats inflation, has low risk compared to my other investments, and has great dividends. They also have retirement pies that are automatically adjusted as time goes on based on how close you are to retirement. To emulate M1 Finance's expert pies, Robinhood users would need to do a lot of research and calculations. Building portfolios from scratch is a barrier to entry, especially for anyone who wants to get started investing today but find it overwhelming or intimidating. The last three categories I'm going to group under trade mechanics. These include trade window, immediate market orders, and advanced market orders. A trade window is a period of time where you're allowed to buy and sell stocks. Depending on your broker, whether it's M1 Finance, Robinhood, TD Ameritrade, or Fidelity, there may be different windows in which your trades are allowed to execute. Market orders are orders to buy or sell stock at the current market price. Immediate market orders execute immediately, whereas delayed market orders execute at a later time. As far as advanced orders, you can do more than just buy and sell stock at its current market price. There are advanced orders, like stop losses or limit orders, which tell your broker to buy or sell stock in the future if the price meets certain conditions. For example, let's say you want to buy Amazon stock. Right now it's trading over $2,000, but you think it's actually worth $1,500. What you can do is place a buy limit order at $1,500, and your trade will never execute unless the price goes below or equal to $1,500. As another example, let's say you bought Amazon stock at $1,500, but you want to take profit exactly at $2,000 or above. What you can do is place a sell limit order, which would not sell your stock unless the price reaches $2,000 or above. Advanced orders allow you to do just that without having to check the chart or the ticker constantly. Do passive investors need a full trade window, immediate market orders, and advanced orders? Well, passive investors have a set it and forget it approach, so they won't be interested in making a short-term profit by getting in and out of a position at specific times or specific prices. They're banking on the stock market consistently going up over a long horizon, so any missed opportunities in the short term is not something they should fret over. If they buy stock and the trade window from their broker is a day out, or they place a market order that is delayed, it won't matter much to the bigger gain their long-term horizon will amass. From my experience, I believe offering such products to passive investors, it just makes things confusing. It's too much control for this type of strategy. Instead of using advanced orders, immediate market orders, or worrying about a trade window, a better strategy for passive investors would be to consistently add money to their portfolio on a monthly basis, and when the prices of stocks go down, they average down their cost. On the other hand, active traders need full trade windows, immediate market orders, and advanced orders. These products allow them to quickly seize as many opportunities as possible. For example, if you're a day trader who needs to immediately get in or out of a position, a delayed market order or small trade window could cause you to lose money. Moreover, advanced orders free up valuable time so that you don't have to watch for buy or sell triggers because your broker will buy or sell automatically at the prices or conditions you set. M1 Finance does not have a full trade window, immediate market orders or advanced orders. They have a small trade window in the morning, delayed market orders, which execute in that window, and they do not have any advanced orders. On the other hand, Robinhood users have access to a full trade window in which their trades can execute. They even have access to pre-market and post-market hours. Robinhood also has advanced orders, like stop orders and limit orders. They even have a trailing stop loss order, which is pretty cool. And assuming that the market is open, market orders in Robinhood execute immediately. So for active traders, Robinhood wins in this category. In this showdown, we have clear winners. For passive investors, M1 Finance wins because it has rebalancing, fractional shares, and expert pies. For active traders, Robinhood wins because it has a full trade window, immediate market orders, advanced orders, cryptocurrency trading, and options trading. Thank you for watching this video. I hope you like and subscribe, and I'll see you next time. Active trade